As a business organization or as an individual, do you sell on credit and do you buy on credit? I mean the goods you deal in. For instance, if you deal in flour, sugar, spare parts, do you sell on credit and do you buy on credit? The answer should be yes, because that's how, or one of the ways to improve turnover. Turnover here means sales. Now, if we sell on credits or buy on credits as a business organization, or even as an individual, it is possible to have so many debtors due to credit sales and so many creditors or suppliers due to credit purchases. But the question is, are you checking how this credit sales is increasing or decreasing your debtor balances, or how the credit purchases is increasing or decreasing your creditors' balances? Well, in order to check and manage these balances, we use the control account. Control accounts are accounts prepared to summarily check an organization's credit sales and credit purchases as it affects debtors and creditors for a particular period. Remember that when we sell on credit, it means that we have customers owing the business. And when we buy on credit, it means we have creditors that the business is owing. Now, there's a need to organize or manage these debtors and creditors balances, such that every item affecting the debtors or creditors are considered to arrive at a fair value for credit sales, credit purchases, debtor balances, and creditor balances. In order to achieve this, there's always a need to constantly check the credit sales and the credit purchases summarily or in total from period to period. The account that we prepare to check this aspect of the activities of the business is what we call the control account. Now, having established that the control account helps to summarily check the credit sales and credit purchases as it affects debtors and creditors, then it means that we can identify the uses of control account. The first one here is to summarily check the total debtors at the point in time. With the help of the control account, the debtors balance can be checked in total at any point in time. Here, you can easily test the total debtors of the business at a particular point, despite the fact that you might have more than one debtors. The second point is to also summarily check the total creditors at any point in time. If you buy on credit, it means that you have creditors that the business is owing. So you can have as many creditors as possible. But here, the control account tries to check the totals, in combination of all the creditors, to test the accuracy or the fairness of the value representing the total creditors at every point in time. The control account also helps in managing the credit sales of an organization for a particular period. Here, it takes into consideration the credit sales and any item that can increase the credit sales or technically decrease the credit sales. the same way, it also manages the credit purchases of the organization, taking into consideration items that can increase or decrease the credit purchases. Because if you are buying from different suppliers, it means you can have as many as you want. But in order to check the balances from time to time, you can use the control account. Now, a very useful instrument for preparing statements for organizations with incomplete records. A business is considered to have incomplete record where for some reason it is not keeping adequate record for transactions or business activities. Sometimes we can say any business that is not correctly applying the principle of double entry is also said to have an incomplete record. In this scenario, we are also required sometimes as professionals to still prepare the statements in that scenario. So usually we adopt the control account in identifying some missing figures, especially credit sales, especially credit purchases, sometimes debtors value, and also the creditors value. So these are the uses of the control accounts. Types of control account. The first one here is the sales ledger control account. Now, what are you trying to control here? Sales, credit sales, basically, and items affecting credit sales. So we can say the sales ledger control account is a control account prepared to summarily check an organization's credit sales as it affects what debtors for a particular period. So what are we saying? When you sell on credit, it has a connection to those owing the business. It has connection to customers owing the business. It has connections to debtors owing the business. So in a nutshell, credit sales has relation to debtors, and debtors are seen as individuals or organizations owing the business. So in order to summarily check or control the activities of credit sales as it affects debtors of the business, we use the sales ledger control account. So another name for the sales ledger control account is total debtors ledger control account. Now, how does the sales ledger control account looks like? Here it is. It has, description, debit, and credit, but you must understand the technique involved in preparing it. The debit side is for items that can increase or that is increasing the credit sales. So what I mean is any item that is interpreted to increase what customers are owing the business is debited to the sales ledger control account. And any item that can be interpreted to decrease credit sales or decrease what customers are owing the business is credited to the what? Sales ledger control account. So this is the simple technique in preparing the sales ledger control account. So once you see the item, try to explain or interpret the item. So if you interpret it properly, you can tell if it is affecting sales. And if it's affecting sales, you ask yourself, is it increasing it in form of credit or decreasing it in form of what? Credit. If it is increasing in form of credit, you debit it to the sales ledger control account. If it is decreasing it in form of credit, you credit it to the sales ledger control account. So let's take an example. Let's take these items. Now look at what you have here. Credit sales. When you sell on credit, it will increase what customers are owing the business. Okay? So that is why you have it here in the debit side. Items increasing the credit sales. You see? When credit sales increase, customers owing the business what? Increased. You see? So the next one says sales journal balance. Sometimes in examination conditions, instead of using credit sales, they use sales journal balance. Remember, in the sales journal class, our sales day book class, we established the fact that the sales journal is used to record what? Credit what? Sales. So in examination condition, they can use it interchange. Instead of using credit sales, they might use sales journal balance. So understand that they are saying the same thing. So when you see sales journal balance, the first thing that should come to your mind is, what is a sales journal? A sales journal is also called sales day book. What is it used for? For recording credit what? Sales. So it means that what you have here is what? Goods sold on what? Credit. So it will increase the credit sales, or increase what the debtors or what the customers are going to be owing the business. So that's why it's in the debit side here. So basically everything that comes to the debit side should be increasing what customers are owing the what? Business. The same thing here, charges on delayed settlement by what? Customer. So if a customer has not settled its bill and you are charging that customer for not settling the bill on time, it means that you are what? You are increasing what the what customer is owing the business. That's why it's here in the debit side. The next one, we have commission disallowed. You allow the customer. When you give a commission to a customer, it technically should reduce what the customer is. But when you are not disallowing it, that means you're increasing it back. Okay? That's why it is here in the debit side. And then we have customers check dishonored. When you receive check from customer for payments for goods that you sold to them on credit, and you took the check to the bank and the bank returned the check. So in that sense, you can say that what that has increased what the customer is owing, because at first you would have reduced it and now the check is returned. So it means you have to now what? It will increase what the debtor is owing. If the customer was owing you 1 million and gave you a check of 500,000, technically, if you have cashed the check from the bank, what the customer is owing you would have reduced to 500,000. But if by the time you went to the bank and then the bank returned the check, what does it mean? It means that what that value goes back to 1 million. So that's why you have it in the what? Debit side. So technically, any item that is interpreted to increase what the debtors are owing the business, okay, is debited to what? The sales ledger control account. And now whatever decreases it is credited. What's the next one? Let's take items here. Cash received from customers. When you receive cash from customers, it will reduce what they are owing. So you credit to sales ledger control account. Check received from customers. When you receive check from customers, it reduces what they are owing. You credit. Discount allowed. When you allow them discount, it means you're reducing what they are owing you. You credit. Bad debt. Bad debt is what? Debt that cannot be recovered. The customer is owing you, say, 100,000, and then for some reason the money can no longer be recovered. So if you're writing it off, it means that what? It will reduce what the customer is what? Owing. Commission given to customers. When you give them commission on sales, it will reduce what they owe. Returns inward. When you sell to a customer and the customer returns part of it, it will reduce what the customer is owing you. That's what you have here. So at the end of the day, you have a balance carried down here, meaning that what? The debit side is higher than the credit side. That's the balance carried down here that becomes the balance what? Brought down. So here you have balance brought forward from the beginning here. So the question can give you opening balance, debit for sales, put it there. Okay? Opening balance, credit for sales, put it there. But what should normally happen professionally is opening balance debit for sales ledger control account. So you put it in the debit side, and if the question is also giving you opening balance credit for sales ledger control, put it in the credit side. But this is what is typically expected. Okay, so at the end of the day, you balance up. Whichever one is higher, you understand? I've already told you how to balance. If the credit side is higher than the debit side, then that means the balance carried down will be in the credit side. So it becomes balance brought down in the credit side. If the debit side is higher than the credit side, the balance carried down will be in the what? Credit side. Becomes balance brought down in the what? Debit side. So this scenario here, the debit side is higher than the credit side. So that's why you have the balance carried down in the credit side. That becomes balance brought forward in the debit side. So technically, you should not forget the approach I've given to you. Whatever is increasing the credit sales or increasing what the customers are owing the business, you debit it to sales ledger contract, and whatever is reducing it or decreasing it, you credit to the sales ledger control account. The next type of control account is the purchases ledger control account. So you're trying to control credit purchases as it affects what? Creditors. You know, when you buy on credit, you have people that you are owing. Okay, so in order to summarily check the credit purchases that affect creditors is what we call the purchase ledger control. So we use the purchase ledger control account to check the credit purchases as it affects what creditors for a particular period. So another name for the purchase ledger control account is total creditors ledger control account. So you have to take into consideration every item that affects the credit purchases, either increasing it or what decreasing it. Okay. Now, how does a purchase ledger control account looks like? I already explained how a sales ledger control account looks like. Now, this is purchase ledger control account. Remember, you're trying to check or control credit purchases. So, credit purchases will affect what creditors. Creditors are those that the business is owing. So, there are two things. Is it that the item is increasing what the business is owing the suppliers, or decreasing what the business is owing the suppliers? So, if it is increasing what the business is owing the suppliers or increasing credit sales, you credit. If it is decreasing it, you what? Debit. That is purchase ledger control account. So let's take items. Remember, I can have opening balance based on the question. You say balance brought forward, credit, that's the expectation. Put it there. Credit purchases. When you purchase on credit, it increases what you're owing the supplier. So it comes here. Purchase journal, the same thing. Purchase journal or purchase day book is used for recording credit purchases. Okay, so that will increase what the business is owing the supplier. So it comes here. Charges on delayed payment. So if we did not pay suppliers on time and they are charging us, it increases what we are owing them. Credited. Commission received cancelled. If we have received the commission and now they are cancelling it, it increases what we are owing the suppliers. Credited. Then we have cash paid to suppliers. When you pay suppliers, it reduces what you're owing them. Debit. Check paid to suppliers, the same thing. Reduce what you're owing them. You see? Debit. Discount received. You know, when you receive a discount, it means there's a reduction in what you're owing. So you debit. Commission received from, so technically any item that reduces what the business is owing suppliers is debited, and anything that increases it is what? Credit. And then at the end of the day, you balance. Balance carried down here is in the debit side. That means the credit side is higher than what? Debit side. So it becomes balance brought forward in the credit what? Side. Now, this is an illustration on the preparation of what? Sales ledger control account and the purchases ledger control account. So here is the question. The following information has been identified from the books of Disallowed Enterprises. You are to prepare the control account from the what? Information. So here, you see all the information here. We have sales ledger opening balance, debit. Purchase ledger opening balance, credit. We have credit purchases, credit sales, charges on delayed settlement by customers, charges on delayed payment to suppliers. We have customers check dishonored, cash paid to suppliers, check paid to suppliers, cash received from customers, check received from customers, discount allowed, discount received, return outward or purchase return. We have bad debt, we have returns inward or return. Now, there's a combination of all the items. So you have to know which one is related to what? Sales ledger control account, and the one that is related to what? Purchase ledger control account. And once you identify the one that affects sales ledger control account, you ask yourself, is it increasing the debtors balance, or it is decreasing it? If it is increasing it, you debit. If it's decreasing it, you credit. If it's affecting purchase ledger control account, you ask yourself, is it increasing the amount owed to suppliers? If it is increasing it, you credit. If it is decreasing it, you what? Debit. That's a simple technique to preparing what? Control account. So let's take the items one after the other. The first one here says what? Sales ledger opening balance debit. So what do? We open our sales ledger control account. As you can see, Disallowed Enterprise sales ledger control account. So we have balance brought forward debit 125,000 based on what we have in the question. The next one says purchase ledger opening balance credit 50,000. So you open purchase ledger control account. You can see Disallowed Enterprise balance brought forward credit 50,000. The next item here says credit purchases. What is credit purchase? That means you're buying on credit. So it's affecting purchase ledger control. So that's the first thing. You now ask yourself, will it increase what the business is owing the suppliers, or it will decrease it? You see? So if you're buying on credit, it will increase what you are owing the suppliers. And remember what I told you, if it is increasing what you're owing the suppliers, you credit it to where? The purchase ledger control account. So we come here, look at it, focus, purchase ledger control account. We have credit purchases credited 250,000. The next item, credit sales. Credit sales. When you sell on credit, it means you have debtors owing the business, so it will affect what? Sales ledger control account. Remember I said sales ledger control account summarily checks what? Credit sales as it affects what? Debtors. Do you understand? So credit sales is affecting sales ledger control account. Remember I said sales ledger control account is also called what? Total debtors ledger control account. Okay, so credit sales will affect sales ledger control account. Now, will it increase the debtors owing to the business? Yes. So what happens when it decreases? You debit. And what happens when it decreases? You credit. So this credit sales now will increase. We increase our what the debtors are going to owe us. So that's why we have a credit sales 500, 200. Okay. The next one says charges on delayed settlement by customers. When you hear customers, for you to have customers, it means you're selling to them. So this item, charges on delayed payment to what? Sorry, charges on delayed payment by customers. That will affect sales ledger control account. Now you're charging them for not settling you on time. So that means that you're trying to increase what they are owing the what? Business. Remember I told you, whatever increases credit sales or increases debtors value, okay, is debited to sales ledger control account. That's what you have here, 37,500. Next one says charges on delayed payment to suppliers. Suppliers have to do with purchases, and that will increase what we are owing the supplier. So we have purchase ledger control accounts. Charges on delayed payment to suppliers, increasing what the credit purchases or increasing what we are owing suppliers. Okay. The next one, we have customers check dishonored. Customer will be related to sales anyway. So now their check that they gave to us is dishonored. So it means that what we thought they have paid, they've not paid. So that will increase what they are owing the business. Okay. So we have sales ledger control account. Customers check dishonored, debited 35,000. The next one says cash paid to suppliers. Suppliers are connected to purchases. Okay. So when you pay them in, you're reducing what you are owing them. So that's purchase ledger control account. Purchase ledger control account. Okay. Cash paid to suppliers. Remember I said if it is decreasing the credit purchase or decreasing what we are owing suppliers, what do? We debit. That's what we're doing here for the 5,000. The next one, check paid to suppliers. The same thing. You're reducing what you're owing suppliers. So we have check paid to suppliers 143,000, reducing it or decreasing it. Next one is check receipt from customers. Customers are related to what? Sales. So you're reducing what debtors are owing the business. So we have sales ledger control accounts. We have check receipt from customers. Okay, can you see that? 350,000. So the next one says discount allowed. When you allow discounts when you sell. So if you're allowing discount, it means you're reducing what debtors are owing you. Okay. So we have sales ledger control account, discount allowed. So you're reducing. Okay. All right. The next one, discount received. You receive discount from suppliers. When you receive discount from suppliers, it means you're reducing what you're owing the suppliers. So we have purchases ledger control account here. Discount received, reduction 12,500. Okay. The next one here is returns outward or purchases return. What's returns outward? You purchase from your supplier, you return part of it to them. That will reduce what you're owing them. Okay. And I told you that if it's in reducing what you're owing suppliers, what do? You debit it to purchase ledger control account. If it is increasing it, you credit. So this is reducing it, so we debit it to purchase ledger control account. Okay. So we have returns inward or purchase return 65,000. The next item just says bad debt. What's bad debt? Debt that cannot be recovered. So who owes? Debtors. Okay. right? And then it is now bad. It means that you reduce what the debtors are owing the business. So that's sales ledger control account. Remember, sales is connected to debtors. Don't forget that. So we have bad debt, reducing it 25,500. Okay. The next one is returns inward or sales returns. What's returns inward or sales return? You sold goods to people or to customers. Remember, when you do credit sales, it's connected to debtors. Now they are returning some back to you. So that will reduce what the debtors are owing you. And I told you, if it is reducing the credit sales item or reducing the debtors value, what do? You credit it to sales ledger control account. So we have returns inward or sales return credited. Okay, that's 95,000. So that's about the last item. So what do? You balance up this sales ledger control account. If you add this, the total debit side here, and add the total credit side, you have the total debit side exceeding the total credit side by 120,200. That's the balance carried down you're having here. So that becomes the balance brought forward in the debit side here. So you go to the purchase ledger control account. You add up the total items here in the credit side and total item in the debit side. So here, based on this question, the total item in the credit side is higher than the total item in the debit side by 59,500. That's the balance carried down you're having here, and that becomes the balance brought forward here. That is the illustration on the preparation of what? Control accounts, sales ledger control, and the purchase ledger control. I encourage you to pick up questions and then attempt them. If you have clarifications on your questions or on this very explanation, you can reach me on 08136506356. So send me an email, jeremiah.dosu@gmail.com, or drop questions in the comment section or inbox me. I'll be there to reply or respond to your questions with the right answer.